17 U.S. states are now questioning the actions of the most powerful financial institutions in the world. Not because of a financial crash, not because of fraud, and not because investors suddenly lost money. They are investigating BlackRock and JP Morgan over something far more uncomfortable: China. For decades, Wall Street repeated a simple belief: that money has no borders, that markets are neutral, and that capital should flow freely wherever returns are highest. But today, state governments are asking a question Wall Street never expected to face. What happens when global investing starts to conflict with national interest? This is not a loud scandal. There are no dramatic arrests or courtroom scenes. This is a quiet shift, a slow change in how power, money, and responsibility are being redefined. Welcome to Finance Historian Time, the channel where we break down financial history and global markets to understand how decisions made far away quietly shape your future. If you value calm, long-form financial analysis without hype or noise, click subscribe and stay with us. And as always, share your thoughts in the comments, because this story affects everyone whose money is invested without them even realizing it. The big picture: to understand why these investigations matter, we need to zoom out. For more than 30 years, China represented one of the most powerful economic transformations in modern history. Hundreds of millions of people moved into cities. Factories expanded at unprecedented speed. Global supply chains reorganized around Chinese production. For investors, this was not just growth, it was inevitability. Wall Street banks, asset managers, and index providers all reached the same conclusion: China had to be part of every serious global portfolio. So they built it in. China entered emerging market funds. Chinese companies entered global indexes. And trillions of dollars followed automatically. Most investors never sat down and decided, yes, I want to invest in China. The system made that decision for them. For years, this arrangement went largely unquestioned. Returns were strong. Markets were rising. Globalization seemed unstoppable. But history has a habit of changing direction quietly before anyone notices. And now, 17 U.S. states are asking whether that system still serves the people whose money is being invested. If you find this kind of analysis valuable, like the video, subscribe to Finance Historian Time, and let us know your opinion in the comments. What does investigating really mean? When people hear the word investigation, they often imagine lawsuits, criminal charges, or financial scandals. That is not what is happening here. These state-level investigations are focused on something far more technical, but far more important: fiduciary duty. In simple terms, fiduciary duty means this: if you manage other people's money, you are legally and ethically required to act in their best long-term interest. State pension funds manage retirement savings for millions of Americans: teachers, police officers, firefighters, public employees. These are not hedge funds chasing short-term gains. They are designed for stability, predictability, and long-term security. States are now asking some uncomfortable questions. Were the risks of investing in China fully disclosed to pension trustees? Were geopolitical risks properly considered? Did asset managers align their strategies with state laws and policies? This is not about whether China investments made money in the past. It is about whether the full range of risks was understood and communicated. Because fiduciary responsibility does not end when returns look good. It becomes more important when risks are hidden. WHY BlackRock and JP Morgan. So why are BlackRock and JP Morgan at the center of this scrutiny? Because of scale. BlackRock is the largest asset manager in the world. It manages trillions of dollars on behalf of governments, pensions, and institutions. When BlackRock adjusts an index strategy or allocation model, money moves automatically, without individual investors pressing a button. This is what makes modern investing efficient. But it is also what makes it powerful. JP Morgan plays a different role. It acts as a bridge between Western capital and Chinese financial markets. It helps create market access. It advises on investment structures. It supports the machinery that allows capital to flow across borders. Together, these institutions do not just participate in markets. They help design how markets function. At this level, investing is no longer just about returns. It becomes structural. And once financial decisions become structural, they stop being invisible to governments. Why China is the focal point? This investigation is not about China as a nation. It is about China as a financial system, a system where the state plays a central role in corporate decision-making, where transparency standards differ from Western markets, where legal protections operate under a different framework. For decades, investors assumed these differences did not matter. Growth would compensate for risk. Integration would reduce uncertainty. Time would solve political tensions. But the world has changed. Geopolitical rivalry has intensified. Trade relationships are being reassessed. And capital is no longer viewed as neutral. State officials are not saying profits are bad. They are asking whether strategic exposure to a geopolitical rival aligns with long-term public responsibility. That question would have been unthinkable 20 years ago. Today, it is unavoidable. And so far, we have seen why these investigations exist, who is being scrutinized, and why China sits at the center of this debate. But the most important issue still lies ahead. What does this mean for pension funds? What does financial history tell us about moments like this? And are we witnessing a deeper shift in global finance itself? That is where this story becomes truly significant. The pension fund dilemma. To understand why this investigation matters so deeply, we need to talk about pension funds. Pension funds are not ordinary investors. They do not trade daily. They do not chase trends. They do not exit positions quickly. They are designed for one purpose only: long-term stability. When a state pension fund invests money, it is making a promise that decades from now, retirees will receive what they were guaranteed. That is why risk matters differently for pensions. A hedge fund can absorb volatility. A pension fund cannot. When pension money is exposed to geopolitical risk, the danger does not appear immediately. It builds slowly, and then it arrives all at once. State officials are now asking difficult but necessary questions. What happens if sanctions expand overnight? What happens if Chinese companies are suddenly restricted from global indexes? What happens if capital controls tighten and money cannot move freely? These are not theoretical concerns. They are risks that pensions, by their nature, are not built to handle. And once they materialize, there is no easy exit. Fiduciary duty vs. global strategy. This brings us to the core conflict. Asset managers like BlackRock operate globally. Their mandate is to maximize risk-adjusted returns across markets. State governments operate locally. Their mandate is to protect public money and public trust. These two objectives are not always aligned. From Wall Street's perspective, diversification into China made sense. It reduced concentration risk. It captured growth. It followed index logic. From a state's perspective, the question is different. Does this exposure align with our laws, values, and long-term obligations? This is why fiduciary duty sits at the center of these investigations. It is not about ideology. It is about obligation. When public money is involved, neutrality becomes harder to defend. What financial history tells you? As financial history offers a clear warning. Markets and politics are never truly separate. During the Cold War, capital flows followed ideology. In the 1980s, Japan's economic rise triggered fear and policy pushback. After 2014, Russia's financial markets were rapidly isolated from the West. In every case, investors believed that markets would remain insulated from politics. In every case, they were wrong. History shows us something uncomfortable. Capital follows power until power changes direction. When that happens, markets adjust violently, not gradually. State governments understand this lesson well. They do not want to discover geopolitical risk after it has already materialized. Is global finance entering a new phase? For decades, global finance was built on a single assumption, that markets would always become more integrated, that capital would move freely, that political borders would matter less over time. That assumption is now being questioned. We are seeing signs of fragmentation everywhere. Countries are reshoring supply chains. Governments are monitoring capital flows more closely. Strategic industries are being protected. This does not mean globalization is ending. It means globalization is changing. Instead of one unified system, we may be moving toward regional financial blocks, and in that world, asset managers will face increasing political scrutiny. Not because they failed, but because their influence has grown too large to ignore. Why this investigation matters beyond China. It would be a mistake to view this story as only about China. China is the trigger, not the root cause. The real issue is control over capital. Who decides where public money goes? Who defines acceptable risk? And who bears responsibility when strategies clash with national priorities? 17 states are not trying to dismantle global finance. They are asserting a right to question it. That alone represents a shift. Once governments begin asking these questions, they rarely stop. What happens next? These investigations may not end with dramatic outcomes. There may be no fines, no lawsuits, no public confrontations, but behavior will change. Asset managers may increase disclosures. States may demand more transparency. Pension funds may reassess exposure, quietly, gradually, systematically. This is how financial systems evolve, not through collapse, but through adjustment. Final reflection: this story is not about whether investing in China is right or wrong. It is about whether global finance can remain detached from national responsibility. 17 U.S. states are not rejecting markets. They are redefining their relationship with them. And that matters. Because when public money is involved, neutrality is not always an option. If you appreciate deep financial history and calm, long-form analysis, subscribe to Finance Historian Time. And leave a comment below. Should governments have a say in where public money is invested, or should markets decide alone? Because in finance, power does not disappear. It only moves.